The following is a production of Professor Robert Barnwell. Each episode includes insights provided by the chairman, CEOs, and CFOs of the world's most successful corporations, as well as thought leaders from premier business schools and international consultancies. If you and your team would like more information on corporate leadership and strategic management, or would like to learn more about Professor Barnwell, his research, and how he may be able to assist your company, please visit Professor Barnwell's website at robertgbarnwell.com.
Hello, and welcome to CFO Talk Radio. I'm your host, Robert Barnwell. During the last episode, we spoke with David Parmenter, a leading author, speaker, and consultant based in New Zealand, about his book, Winning CFOs, Implementing and Applying Better Practices. This is episode 12, which marks the beginning of a special four-part series featuring several senior professionals from KPMG. During this first part of the series, we speak with Joe Rodgers, a managing director with KPMG's Corporate Finance Group, about the current state and market outlook for acquisition financing. Joe, welcome to CFO Talk Radio.
Thank you, Robert. I'm glad to be here.
I hope you'll forgive me for being a little dizzy when it comes to the subject of acquisition financing. I think it was perhaps up until the spring or summer of 2007, the bankers were essentially throwing bales of money at acquisition transactions, and they were able to do that with the support of collateralized loan and collateralized debt obligations. And then I guess, whoosh, it all seemed to disappear in the credit crisis that took hold during the summer of 2007. Where do we stand today in terms of access to debt financing for acquisitions?
Well, Robert, I'm glad that I have a box of tissues nearby because you're bringing tears to my eyes because I helped start up a new commercial finance company back in the middle of 2006, and it was structured as a CLO, and so I was caught right in the middle of it during the meltdown in the middle of 2007. But in general, I would say today the debt market is definitely back. Loan volume is up over 200% year over year. But candidly, the preponderance of the deal flow is really primarily in repricings as borrowers are taking advantage of the window being open and pushing their lenders to lower pricing and longer maturities. Regarding acquisition financing, funding is definitely there for those deals, but so much of it still depends on pro forma combined financials, overall valuation, capital structure. And capital structure, I mean debt versus equity and the different percentages for each in that capital structure, and then the various deal terms. I mean, deals are getting done with a combination of senior debt and institutional debt or high yield. It seems like institutional investors have definitely come back into the debt market, as I think most of them are buying into the recovery.
Well, during the go-go years that led up to the credit crisis, many corporations were forced to the merger and acquisition sidelines as private equity firms took the lead, driving valuation and debt multiples to what I would say were insane and indefensible levels. However, let's make no mistake, the private equity firms still have a lot of dry powder in terms of financial overhang. I think before we started the interview, we guessed $200 billion or more that they still have committed. But given the state of the credit markets, has the power shifted to the strategic or corporate buyer?
Robert, I'm not really seeing that much of a paradigm shift, but as you know, a strong strategic buyer should always have the upper hand against a financial buyer to the amount of synergies and economies of scale that make the deal more accretive for them. That said, more private equity groups, I think, are definitely getting more anxious to put money out because, as you mentioned, there's a lot of dry powder out there and investment windows are closing. I know we're beginning to have more dialogue with owners about various liquidity options, but up to this point, it sure seems like M&A activity has been slow due basically to lack of funding, but most recently due to a difference in valuation expectations between buyers and sellers. And I think before a buyer is going to pay up for a company, it wants to make sure the recovery is sustainable. Finally, you just can't have a robust M&A market without a robust debt market. But I can tell you this, everything I've been hearing and seeing, EBITDA is definitely improving across the board out there. Companies are definitely doing better. As they do better, cash flow is improving. They're paying down debt, and that's definitely going to make their balance sheets that much stronger in order to go out and make acquisitions.
All right. Well, assuming that the power has shifted, a little bit, back towards the corporate buyer or strategic buyer, let's talk a bit more about acquisition financing. Am I wrong in saying that the banks haven't increased their appetite significantly in terms of holding acquisition debt on their own books? I mean, you mentioned there's some pricing resets, there's some changes in maturities, and if the banks aren't in the market for new acquisition financing, and I'm not saying that's the case, I'm just asking it here, I haven't seen a great deal of appetite for debt securitization such as CDOs and CLOs, at least certainly not the level that we saw pre-2007. So essentially my question is, what does this mean for corporate buyers in terms of financing alternatives for acquisitions?
Yeah, as I mentioned earlier, Robert, institutional investors are definitely back in the market. As many deals that are getting done with senior debt are using term loan Bs and or unsecured high yield debt to fill holes in the capital structure. The good news is that banks are using their balance sheets again to underwrite, and this obviously eliminates deal uncertainty. And in regards to CLOs, Robert, believe it or not, I've recently heard of a handful of CLOs getting done, but only with seasoned investors. And it appears that most of the hedge funds have also improved and fixed their liquidity issues, so they're also back in the market. What does this all mean? I think it means that if you're a company out there looking to make an acquisition or looking to do some type of market event, that there are definitely more financing options out there available to you.
Interesting. I think that's really encouraging, particularly for the corporate buyers. Now, up to this point, we've talked a lot about the availability of debt financing in terms of how we might choose to finance an acquisition, or availability of bank debt. But really, that only tells part of the tale. Assuming that the capital markets are stable and behaving in a more normal manner, acquisition financing is typically available at any price. So let's take a closer look at some of the considerations that we should keep in mind in terms of financing acquisitions and making a broad choice between, say, debt and equity.
I think it comes down to two factors. One is weighted average cost of capital, and two is the internal rate of return on that investment. As an acquirer, you need to really figure out the optimal capital structure. For private equity groups, LBOs aren't getting done with equity less than 35 or 40% of the purchase price. And just, if I can, let me share with you, as the market does improve, let me share with you some of the market data that I've recently seen this year versus last year. For example, first lien debt, leverage around first lien debt is higher, 3/4 of a turn higher than it was last year. Total debt now is a half a turn higher than it was last year. And all-in spreads this year versus last year, the deals that are getting done this year versus last year have improved one full point. So the market is definitely coming back. And with the market rebounding and companies having access to more financing options, I think it's important, it's very imperative for companies to understand what is available out there and how to negotiate the best terms possible. Part of what we're doing inside Capital Advisory at KPMG is helping companies assess their capital structures vis-a-vis their strategic plans, which might include potential acquisitions, and provide market guidance and solutions around those plans.
All right. Well, there's an old saying in mergers and acquisitions that either you can name the price and I can name the terms, or you can name the terms and I'll name the price. So outside of capital structure decisions, what other terms and considerations should the corporate finance team consider when structuring a transaction? And here I'm talking about affirmative, negative, and financial covenants, as well as structuring earn-out provisions and other structural elements.
Yeah, negative covenants have definitely become much more restrictive than affirmative covenants. Lenders tightened up on such negative covenants as liens, additional indebtedness, sale of assets, acquisitions, investments, and restricted payments. That said, as the market is coming back, lenders are loosening up on those reins. I mean, believe it or not, covenant-light deals are making a comeback, and deals are now getting structured again with defined buckets for even permitted acquisitions and restricted payments such as dividends. The deals that include financial covenants include such covenants as leverage, both senior and total debt, fixed charge, tangible net worth, and minimum availability. And the minimum availability covenant is really just primarily pertains to asset-based lending deals. And in regards to earnouts, Robert, I think they still remain very common, and they continue to be a viable option as buyers and sellers try to bridge valuation differences.
All right. Well, before we let you go, do you have any parting suggestions or thoughts that you'd like to share with CFOs and their corporate finance teams as they consider financing a pending acquisition?
Probably two things. I mean, I think that company CFOs really need to make sure to do the proper due diligence and get a firm grasp around synergies and economies of scale. As you probably know, so much of M&A is structured around pro forma EBITDA, and capital providers will thoroughly scrub the numbers to make sure that those numbers are legitimate. Finally, and as I said, the debt market is back, and depending on the acquirer's balance sheet and capital structure, companies are beginning to gain more leverage with lenders, so don't be afraid to use it when negotiating acquisition financing.
Well, today we've been speaking with Joe Rodgers, a managing director with KPMG's Corporate Finance Group. Joe, I really appreciate you visiting us today, and really, I guess the takeaway message here is one of encouragement with regard to the availability of acquisition financing for corporate borrowers. I hope that you'll agree to join us again sometime soon, and we can follow up this discussion and the state of the market again then.
Robert, I really enjoyed it. I'll do it anytime. Thank you very much.
That was Joe Rodgers, a managing director with KPMG's Corporate Finance Group, discussing the current state and market outlook for acquisition financing. Please join us for our next episode when we bring you part 2 of a special 4-part series featuring several senior professionals from KPMG. During this second episode, we'll be speaking with Steve Miller, the national leader of KPMG's Integration and Separation Services practice, about the challenges of merger integration. Until then, this is Robert Barnwell and CFO Talk Radio wishing you all the best.
We hope that you have enjoyed this episode and found the material of value. To download a transcript of this episode, receive a free subscription to the show, or to learn more about this subject, we encourage you to visit Professor Barnwell's website at robertgbarnwell.com to explore the many executive briefings, presentations, case studies, and other resources available for immediate download. This has been a production of Robert G. Barnwell. All rights reserved.